Okay, welcome everyone and good afternoon. Today we're going to be talking about how to trade debit spreads for those of you that are trading options. This is a really important topic because debit spreads is really one of the most efficient ways for you to take a directional view on an underlying stock or ETF utilizing options. So regardless of whether you're brand new to options trading or you're an experienced options trader, this is certainly one of the strategies that you should learn about and understand how to utilize it correctly, because most of us trade options because we have some directional view on the underlying stock or market or a specific sector that we want to be able to take advantage of them. And if you're only trading stocks, you have limited possibilities as to how to actually take advantage of a bullish or bearish view. So options really allow us to take that directional view, number one, with limited risk, and number two, with some leverage so that we can amplify our returns if we are correct, but at the same time limit our losses if we're wrong on that trade. And debit spreads is a really important type of strategy to learn in order to take that directional view. So that's what we're going to spend some time on. It's one of my favorite trading strategies, so I'm really happy to share this information with you guys. My name is Tony Zhang. For those of you that have never seen one of my webinars before, I'm the chief strategist here at OptionsPlay, which is a tool that you all have access to free of charge for the Canadian markets, thanks to the TMX. So we're going to spend about 15-20 minutes going through slides, and what I'm really going to go over is helping you guys understand what are debit spreads, when should you utilize them, how to trade them effectively, and then lastly, how to manage them, how to manage a debit spread, meaning how do you take profit, how do you cut losses, those types of things. And we're going to go through some slides in order to teach you these concepts and best practices. But most importantly, what I want to spend the time on today is actually showing you the OptionsPlay tool that not only will allow you to better understand what I'm teaching here today, but also showing you on the tools that you guys have access to. So immediately after we finish this webinar, you guys can actually start utilizing OptionsPlay and doing the type of analysis that we're going to show you here today. So this webinar is recorded for those of you that are new to OptionsPlay or new to some of my webinars. I highly recommend that you don't necessarily take a lot of time taking notes, but just listen along, because you will have the webinar recording for you to view afterwards. And also what I do is I send out the slides with the webinar recording so that you don't have to write down any notes. I'll send you the slides so that you have all the important information as you follow along to the recording. Now, in those slides are some important links. So especially when I reference other webinars that we've done or previously recorded webinars, the links to those will be available in those slides. So if you're wondering where those links are, just make sure you look at the slides that are sent to you after we finish today. There are some also important links for those of you that have never accessed OptionsPlay. You have free access in Canada for OptionsPlay Canada, so please make sure you click on the link to see what we're going to show you guys today so that you have access to the same tool. And for those of you that trade US stocks or US securities and you want to apply this there, there are also links to how to access this for the American markets. So with that, let's go ahead and get started. Today we're going to cover what are debit spreads. Now, before I actually get started and start talking about debit spreads and best practices and how they work, I just want to do a quick poll here. I want to get a feel for who's in the room. I just want to get an understanding of what everyone's options trading experience is. So please answer the poll. I want to get a feel for how many people have traded debit spreads, how many people have traded options but have not traded debit spreads, and then how many of you are just brand new to options. So it looks like most of you have voted here. So a quarter of you have traded debit spreads, about half of you have traded options but have not traded a debit spread, and about a quarter of you have not traded options before. Okay, great. So that's a pretty even split. The majority of you have not traded debit spreads, which is good, because I really hope that for those of you that have not traded a debit spread before, you're going to learn about some of the benefits of the strategy and why you might want to consider utilizing the strategy compared to just buying an outright call or a put. For those of you that have traded debit spreads, I really hope that the tool that we're going to show you here today shows you how quickly you can find debit spreads or the optimal debit spread for your trading. Because finding the different strikes and expirations sometimes can be quite a time-consuming task. So we want to show you how you can shave that research time down from a few minutes down to a few seconds. And then for those of you that have never traded an option before, I really hope that this kind of inspires you to take a look at some of these strategies, especially if right now you're only trading stocks. Taking a look at how these types of option strategies and comparing it to buying a stock will help motivate you or potentially inspire you to take a look at some option strategies. And our tools are designed to make it as easy as possible for you to compare simple option strategies with debit spreads, and even for those of you that have never traded an option before, compare that to just buying a stock. So that's what we're going to go through here today. So today right off the bat, I want to define what is a debit spread. Now, before I get into the construction of things, I just want to talk about it on a high level. Debit spreads are very simple strategies that allow you to take advantage of either a bullish view on an underlying stock or ETF or a bearish view on an underlying stock or ETF. So when you're trading a debit spread, if you're bullish, you would trade what we call a bull call spread or a bull call vertical, a long call vertical. And then if you're bearish, you trade what we call a bear put spread or a long put vertical. So these are the two strategies. This is what we call a debit spread. How do you actually construct a debit spread? I'm going to first of all use an example of stock XYZ trading at $100 for this example of what a debit spread is. Now, before we kind of talk about the construction of it, the one thing that I think is really important to understand about debit spreads that's different from pretty much all other forms of trading is that you have a defined risk and reward of each spread before you get into a trade. And this is really important for those of you that understand the importance of risk management and money management, because when you're able to define your risk and reward before you get into a trade, nothing really comes as a surprise because you already know what your best case and worst case scenario is, and it can't go beyond that, which is really important for the emotional aspect or psychology of trading, because a lot of times we plan for something and if it doesn't go as planned, sometimes our emotions gets the better of us and we deviate away from our plan. Versus with debit spreads, you know exactly what is the possible outcomes, which makes it a little easier for you to plan for it and actually execute on your plan because you're already mentally prepared for what is the best case scenario and worst case scenario. So that's one of the key things about debit spreads that make it one of my favorite trading strategies, because it really allows me to plan out my trade correctly before I get into a trade. Nothing surprises me, and then it allows me to execute on my plan once I'm in the trade, whether the trade goes in my favor or goes against me. I'm already planned for that, and it allows me to rest a little easier when I'm trading these types of spreads versus some other types of strategies that may have unlimited reward or unlimited risk. That just makes it a little harder to plan for. So in this example here, I'm going to use stock XYZ trading at $100. This is a fictitious stock, and I'm only using this for round numbers to make it easier to illustrate how to construct them. But we're actually going to show you some real examples of real stocks in a little bit, so that makes it a little bit more tangible for you, so that not only do you learn how to construct them from a conceptual perspective, but more importantly, you feel that you have the tools to actually implement these on the stocks that you really trade. So when we're talking about a bull call verticals, this is a vertical spread that you would trade if you're bullish on an underlying stock. What you do is it's constructed of two legs, two option strategies combined into one strategy. So the first leg is we're buying a $100 call, so an at-the-money call, and let's say we pay $4 for that call. This is what you would typically do if you were just an options trader trading a single leg option. If you're bullish on that stock, you buy a call option. But now what we're going to do as a debit spread trader is not just buy a call option, but we're also going to sell a call option against that. So let's say we sell a higher call, in this particular case a 110 call, and let's say we receive a $1 credit in order to do that. So for that, what we're going to receive is a trade that has a max risk of $3 because we've paid a $4 debit and we've received a $1 credit. That net comes out to be $3. And just like when you're buying a call, your risk is limited to what you've paid. So if you're paying $3 for this trade, then your max risk is also $3. but in your max reward is the distance between the two strikes. So $100 call versus a 110 call is a $10 distance minus the $3 risk that you're taking tells you what your max reward is. So your max reward and max risk is always going to sum up to the distance between the two strikes that you're buying and you're selling. And the amount of money you're risking is how much you've paid for the debit spread, and the reward is all of the remaining distance between the two strikes. So that's how you construct a bullish or bull call vertical, and this will allow you to take advantage of the stock moving higher above $100. And we're going to go through some real examples to see exactly when these strategies make money and when they risk and when they lose money, with more tangible examples. And I think that's going to be a little easier for most people to understand when you're actually seeing this on the stocks that you actually trade. Conversely, if we're looking at a bull put vertical, this is where we're bearish on stock XYZ. What would you do if you were only a stock trader? You would have to short a stock, which has a lot of other problems because you have to be able to borrow that stock. You have unlimited risk when you short a stock. So what options traders do is they typically buy a put option. Put options allow you to take a bearish view on a stock, but it has limited risk. So even if you're wrong on the trade, you're only risking a certain amount of money. So in this particular case, let's say we buy a $100 put, and at the money put, let's say we pay $4 for that at the money put. Now, as a debit spread trader, what we're going to do is we're also at the same time going to sell another put. We're going to sell a $90 put against that. Let's say we receive a $1 credit for that. So our net debit again is $3 because we received $4, we're paying $4 debit, and then we're receiving a $1 credit. So that net result is a $3 credit, a $3 debit, which makes our max risk again $3 because that's how much we're paying for the vertical. And just like the previous example, the distance between the two strikes is $10 between the $100 put that we've purchased and the $90 put that we sell. So the remaining distance between that, the vertical width is the max reward here. So our max reward is $7 on this particular trade if stock XYZ goes down to $90 or lower. And the goal of trading these two strategies is very simple. We're trying to profit from a large directional move on stock XYZ. So before we move any further, I want to make sure that everyone understands what a debit spread is before we talk about when you should use it and how you profit from that. It's a very simple construction. Now, you don't have to memorize how to construct these because OptionsPlay will actually do it for you, but this is really for illustrative purposes so you understand what is the makeup of a debit spread, how to calculate max risk and how to calculate max reward, because that really helps define, what is the best case scenario in your particular case and what is the worst case scenario, so you have that defined before you go into a trade. So, what is the debit spread strategy? Number one, debit spread strategy tends to work a little better on individual stocks than ETFs and indices. And the reason for this is because individual stocks tend to have larger jumps. They tend to have catalysts that move them in larger moves than most stocks or indices. Indices and ETFs tend to have more orderly moves. They tend to not have gaps because there's no corporate actions, there's no earnings, there's no there's none of these events that generally drive huge gaps in the underlying in an underlying on ETFs and indices. But individual stocks are susceptible to news, product announcements, merger and acquisition rumors, things like that that can really move a stock. And that's why the debit spread strategy, because it's taking advantage of big directional moves, tends to have better results on individual stocks than on ETFs and indices. When it comes to expirations, this is really where we find you want to trade longer dated options for debit spread strategies. And the reason for this is really because longer dated options minimize theta, because time decay is the factor that's working against you when you're buying an option. You want to minimize that time decay, or what's causing the erosion of the value of your option that's working against you, by buying longer dated options. Longer dated options have less theta, they have less time decay, so they're less sensitive to that. So we generally find that when you're trading debit spreads, you want to trade expirations that are at least 5 to 8 weeks out, if not further. Sometimes you can even trade a 2 or 3 month expiration. Even if you only intend on being in the trade for a few weeks or a month, you can always buy a longer dated option and sell it at before expiration. And lastly, when it comes to picking strike prices, the best practices that we generally see with debit spreads is always buying a slightly in the money strike. So regardless of whether you're buying a call or a put, buying that call or a put that's slightly in the money, and then on the short leg or the leg that you're selling, you always want to sell out of the money strikes that are further away from the current price that still receive some credit so that to offset the cost of the long leg, but it's further enough where there's a relatively low probability of the stock hitting those strike prices. So that is just a quick recap of the debit spread strategy. They're generally used for individual stocks. You want to make sure you use at least 1 month expirations, if not further out. And then with the strikes, you want to always buy the in the money strikes and sell out of the money strikes. So before we actually better understand debit and credit, debit spreads or any options trading really, I think it's really important for us to discuss a concept that is the trade-off between probability and risk reward. And the reason that I want to bring this up is because debit spreads, generally speaking, have relatively low probability of success or low probability of profit. And I hear a lot from users saying, that will ask me the question, why would anyone trade a debit spread if you have the probability of winning less than 50%? And I think that that is a huge misconception that a lot of people have with trading, is that you always want to have high probability. And the reason for this is because high probability sounds good. However, I think most people may not understand is that high probability is traded off by risk reward, meaning with any type of trading that you're doing, it doesn't matter whether you're trading options, whether you're trading any other strategy, whenever you have something that has high probability, that generally will have poor risk to reward. And anything that has good risk to reward will typically have low probability. And that's just the trade-off that you always will have with any form of trading. And it's a matter of finding a level that's suitable for you, a level that's comfortable for you. But more importantly, what you really want to find is how well balanced those two are. So we generally find that when you're trading near the money options with the debit spreads, or even if you're just buying an at the money call or an at the money put, just when we're not even talking about complex trades, you're generally going to find higher probability of profits versus a lower risk to reward. Meaning your risk to reward when you're buying an at the money trade will be something where you risk $200 to try to make $500. Which in my opinion is still a good risk reward. That's the type of risk reward that when I'm a trader, I tend to look for, and I'm willing to trade off a 33% of my, 66% of my trades being losers if I'm making a good risk reward on that trade. Conversely, you can also buy far out of the money options. So you can buy an out of the money option, which will give you even lower probability of profit, where maybe only 15% of your trades are winners, 85% of them are losers, and a lot of people will avoid this. However, the trade-off here is that you're going to have really good risk reward. So you're going to be risking small amounts of money to make large amounts of rewards if you are correct, even though you're correct less frequently. However, when you are correct, you're going to make up for a lot of those smaller losses. So it's really a matter of understanding that there's a trade-off between the two. And if you're only looking for high probability, or you're only looking for high risk reward, you're only looking at half the picture. Make sure that you're looking at both sides of the picture. That's really important to understand when you're trading any form of options, not just debit spreads. So what are optimal debit spreads? We looked at, you can trade high probability debit spreads, you can trade low probability debit spreads. What's best? And what we generally find is that the optimal debit spread is where you're buying a call that's about a 60, or this is not just calls, this is really for calls and puts, right? Sorry. This is when you want to buy a 50 to 60 delta call or a put, and then you want to sell a 10 or a 15 delta call or put against that long call. So that's where we generally find is the optimal debit spread, where the premium of the short leg, the leg that you're selling, will offset about 10 to 20% of the premium of the long leg. That's usually the type of sweet spot that we see with trading debit spreads that we always tell users to start off with. So if you're trying to figure out where you to start off, this is usually a good starting point for when you're trading a debit spread, whether you're bullish or bearish. And these types of when you're buying a 50 to 60 delta call or a put and you're selling a 10 to 15 delta call or put against it, you're generally going to find these trades have higher probability of profits for debit spreads. These will have anywhere from 30 to 40% winners. And you're going to risk roughly about $100 for every $250 reward on that specific trade. And the real benefit of trading debit spreads versus just buying an outright call or a put is simply three things. Number one, you're lowering your risk because you're selling a call which offsets the cost that it takes to get into the trade. That defines your absolute risk. So the more premium you receive on the short leg, the less risk you have on the overall trade. Because you're paying less for that trade, your break-even prices are also going to be a little closer to the current price, which means that the stock does not need to move as far in order for your strategy to break even or become profitable. And lastly, because you're also short a leg, you're offsetting some of that time decay because you have one short leg that's time decay is working in your favor that offsets some of the time decay on the long leg that's working against you. So you have lower theta or lower time decay, which means that you can stay into a trade a little longer without having so much of your value of the option eroded against you. So these are really the prime reasons of why trading debit spreads is one of the most efficient ways to take a bullish or bearish view on an underlying stock or ETF that you have a directional view on. So when should you actually use debit spreads? So this is really important because I've seen debit spreads used, in my opinion, incorrectly. And it's really important to understand that debit spreads are really useful for very specific types of outlooks on an individual stock. And they shouldn't be used in any bullish or bearish directional view. So debit spreads are really only useful when you're expecting a large directional move, a bullish or bearish move in one direction or another on an underlying stock. And the key word here is large, meaning if you're expecting a fairly modest move or a move to happen relatively slowly, debit spreads may not be the right strategy for you. And really, there's no way to figure out which one's best for you unless you actually put the two side by side. And that's what we're really going to show you here today is the tools that you need to decide, is the stock going to make a big enough move for debit spreads to be worth my while? Because you need some tangible numbers in front of you in order to make that decision. We want to show you how you can analyze it so that you can make those decisions yourself. So these types of trades are generally useful for when you're expecting a breakout or a breakdown for a stock. So if you have a stock that's trending higher and you think it's about to break out to the upside, I think a good example of this is some of the weed stocks and what they've done over the last few weeks. These are stocks that broke out and made some huge gains in one direction or another over a very short period of time. These are the breakouts and breakdowns that typically are very useful for trading debit spreads. Another thing that we tend to look for is relative strength in the trend lining up. So meaning if the stock is a strong stock and it's in bullish trends, these are the types of stocks that you want to look for, call debit spreads. For stocks that have weak relative strength and bearish trends, those are the types of stocks that you want to look at. Put debit spreads. And lastly, again, you do not want to use them when you're expecting a modest move in the underlying stock. So if you think the stock's going to make a small move, you don't think it's going to move a lot, but you do think it's going to move slightly higher or slightly lower, debit spreads may not be is not the right strategy to utilize if you're expecting a small or modest move. And lastly, if you're bullish on a stock, you want to buy the call debit spread. If you're bearish on the stock, you want to buy the put debit spread. So just a quick reminder as to which one to trade, whether you're bullish or bearish on an underlying stock. So here what I have is I wanted to put on a chart to illustrate kind of when it's ideal to trade a debit spread. And for those of you that have experience trading debit spreads or trading other strategies like credit spreads, this is, we've done a separate webinar on the difference between the two. And if you're interested in trading credit spreads, we also have a separate webinar on that. But what I wanted to illustrate is the difference between the two so that it really helps define when you should use a debit spread. So here I have an example of a stock that's trading at around 100, which just happens to be near 100, where the stock hit a resistance level, came back down, hit a support level, went back to resistance level, and created this kind of triangle formation. Any of you that follow charting or use technical analysis may be familiar with this type of pattern. And what we saw was that this stock traded within a tight triangle until it hit the apex, and finally it broke above that top trend line. So this is really at the point where you would expect that a stock is trading within a range. That range is getting narrower and narrower, and it finally broke to the one side or another. These are the types of trading setups that you would typically expect to follow with a big, quick move in one direction or another. So in this particular case, I think the move that's expected is a bullish move because it broke that top trend line. And as you can see, these types of moves happen relatively rarely on this overall chart. There's not many times in the chart where you can identify a potentially large breakout. Conversely, for those of you that use technical analysis like the oscillators, like I have a stochastic oscillator here at the bottom, you'll see that this oscillator hits oversold multiple times within a very short period of time and hits overbought within also a very short period of time. So when you're expecting a small modest move because the stock is overbought or oversold, that is again not a scenario where you typically use a debit spread. That's more suitable for when you are trading a credit spread. So keep that in mind, that when you're trading debit spreads, they're more of one-time opportunities that you find on individual stocks. So if you're a debit spread trader, you're typically trading debit spreads on lots of different stocks because these opportunities like these breakouts don't happen very frequently. Versus for those of you that are trading credit spreads, they tend to happen very frequently over on the same stock over and over again. So if you're a credit spread trader, you tend to trade credit spreads on the same stock over and over again versus debit spreads, you tend to trade different stocks all the time. So that's another key fundamental difference between trading debit spreads and trading credit spreads. And I hope this image kind of helps illustrate a little bit about the differences and when you should utilize, and make sure that you don't confuse the two and utilize them in the wrong fashion. So lastly, how do you trade debit spreads effectively? Now, with all types of trading, it doesn't matter whether you're trading options or stocks or futures or currencies, risk management really is key. As a strategist, I've worked with clients from over the last 12, 13 years, just about every single asset class. And I've worked with clients with just about every single possible trading strategy under the sun. And the one thing that has held true over those years is the traders that really knew how to manage their risk were the ones that were most successful. So that's really one of the keys to successful trading. And debit spreads is extremely useful from this perspective because it makes the risk management piece of it so easy and clean to follow and understand that it's really difficult to screw up unless you just simply don't follow it. So like we said before, when you're trading a debit spread, you want to time your entry when you expect a large move in one direction or another. And this is a strategy that, generally speaking, once you're in a trade, how to manage that trade is pretty straightforward. Number one, you want to cut your losses if the move that you're expecting, the large move that you're expecting, does not materialize. So if, let's say on this particular trade before, I'm expecting a breakout, but that breakout never really materializes and the stock just keeps trading sideways. No matter how much money I've made or lost on that trade, it's time to get out because my expected move did not happen. So number one, if the expected move that you're expecting does not materialize, make sure that you simply get out of the trade. Second thing about debit spreads is that almost always you want to exit the trade before expiration, either at a gain or a loss, but you want to exit them before expiration. So this is typically not the strategy that you hold on to all the way till expiration. You can do so, but if you do that, you're going to notice that time decay is really going to erode a lot of the value of the option, and that's really when you're going to be able to that's when you're not going to see the same type of success as someone who's able to take profits and cut losses at the right time. Now, the next thing that I want to talk about is really when you should cut losses and when you should take profit. And this is, again, one of the reasons why I really like to trade debit spreads, is because regardless of how you pick your strikes, regardless of how you pick your expirations, the rules for cutting losses and taking profits for debit spreads are all the same. Unlike other types of strategies like credit spreads, where when you take profit and when you cut your losses is heavily dependent on what strikes you pick, debit spreads, you can really apply the same rules every single time, which just makes it a little easier to follow, in my opinion. So if you struggle with the emotions of your trade once you're in there, a lot of times people struggle with this of taking profits too early and waiting too long to cut their losses. The rules for debit spreads are pretty straightforward. You want to cut your losses when you've lost 50% of the premium that you've paid on the trade. And to take profits, you want to at least take partial profits when you've reached 75 to 100% gains on the trade that you've made. So this is really for those of you that are trading multiple contracts. If you're trading 10, 15, 20 contracts, you want to make sure you take at least partial profits at these types of levels. And if you want to hang on to another portion of your trade for even higher gains, you certainly can. But you certainly want to start taking some profits off the table at between 75 and 100% gain on a trade. So this really helps you plan ahead so that you know exactly, if I've made this much money, this is when I cut my losses. When I made this much, if I've lost this much money, this is when I cut my losses or when I take profits, which is a little different than when you're just buying a call. Because when you're buying a call, if the stock goes up by 10%, or if the stock goes up by 5%, depending on when that move happens, you have different returns. And that's really sometimes difficult because you have unlimited upside when you're buying a call. So how do you determine when you take profits? Sometimes that's a little difficult. And especially if those of you that are trading strategies with unlimited risk, that's even harder to decide exactly when to take profits and losses. So that's really why I like trading them, because I know exactly what my best case scenario or my worst case scenario, and I've planned for it ahead of time as to exactly when I would take profit and when I would cut my losses. Just makes the emotional side of managing a trade a little easier, because that is usually one of the hardest parts for people to manage once they're in an actual trade, is their emotions. So let's actually take a look at some real examples of stocks. I have a couple of bullish and bearish stocks that we can look at for illustrative purposes to show you how to utilize this tool OptionsPlay to help you find the debit spreads, help you analyze and compare buying a stock to buying a call to buying a debit spread, so that you can actually definitively say whether a debit spread or buying a stock or buying a call is the best suited strategy for you. Now, before I get into those examples, I just want to do a quick introduction of OptionsPlay. This is the tool that you guys all have access to free of charge, thanks to the TMX. Now, the reason we created this platform was because we know that when you're trading options and you're looking at a page that looks like this, sometimes if you're a beginner, this page is quite overwhelming. It's really difficult to, number one, understand what you're seeing. Number two, figure out where you should start, both on expiration dates, strike prices, strategies. And more importantly, once you learn how to use this page, especially for those of you that are experienced in options trading, you're going to realize that there's certain things that you can't do very quickly on this page, such as compare two vertical spreads one next to another. Or if you think that the stock's going to go up 10%, how much money do I make from each strategy? How much money do I lose if the stock goes down 10%? These types of analytics, which are really important in helping you decide what to trade, aren't available to you on the screens. And even if you knew how to do back of the envelope and calculations like I had to do back in the day, you realize that it's really difficult to plan for these types of trades when you don't have concrete numbers to see in front of you and you just have some scribbled notes on the back of a napkin. So what we wanted to do is create a platform that provided all of those things so that a beginner can really start exploring and looking at strategies without feeling lost and confused. And for those of you that are experienced, we wanted to put all the things that you needed to analyze a trade in your fingertips right in front of you with concrete numbers so that you can definitively say which strategy is best suited for you and which strategies are not. So what I'm going to walk you here today through is the actual platform, showing you some ideas, showing you how to structure a trade around those ideas, and being able to do these analytics that we're talking about here today. So the platform itself is divided into three sections. We have trade ideas and watch list here on the left. We have our security analysis panel here in the middle, and then we have trading and income here on the right. So these three panels represent what we call the what, the why, and the how. Because every single day you want to know what symbols should I look at, why should I look at those symbols, and lastly, how do I actually trade those symbols? So today what we're going to look at is two stocks that I've pulled out because these are stocks that are fairly relevant and stocks that many of you probably follow or are familiar with. First, I'm going to look at Canopy Growth. Very strong stock, especially in the news recently, with Canada kind of being a leader, in my opinion, on some of these cannabis stocks. Canopy Growth certainly is one of the most talked about. So let's take a look at, if you have a bullish view on Canopy Growth, how can you actually leverage options to take that bullish view compared to just buying a stock or buying a call? So at the bottom of every single symbol, you have two options. You can click on I'm bullish, or you can click on I'm bearish. So this is a strong stock. It's, you know, finally consolidated a little bit after the last few crazy days or last few crazy weeks. And let's say you think that this stock's going to shoot higher. You know, it's sitting around $665, $64 was a bit of a support area, consolidated in this area, and you think it's going to maybe shoot back higher. You know, this stock made a pretty nice climb from about 40 bucks to about, you know, $65. So about a $25 move over just a few short weeks. So it's not crazy, even though there are some downside risks to this trade, in my opinion, and that's one of the key reasons why I think options is better suited for this trade. Is that there's downside risk, but there's also lots of upside potential of the stock hitting $80, even $85, in my opinion, to the upside. So the question is, how do you actually take advantage of that? So traditionally, if you're just buying stock, you can buy 100 shares of that stock, which costs you $6,700. If you bought a call option, which is the simple option strategy that you can trade, you can buy in November at the money puts for about $1,000. That's about a sixth or a seventh of the price of buying 100 shares. So you're saving a substantial amount of capital to buy a call versus buying 100 shares of stock, and you're reducing your risk. But if you can see the spread here on the right, this is the debit spread that we're learning about here today. That only costs you $730. So only about 10% of the underlying cost to buy 100 shares, you can gain that directional exposure using a vertical and still limiting your risk. So let's take a look at a few different examples here. I talked about, you know, Canopy Growth is trading around 67.95. What happens if this stock goes up to 85, which is roughly about a $12 move to the upside? You know, we just said the stock moved $25 over the last couple of weeks. So I think a $12 move higher is not out of this world, especially over the next 45 days. So we're talking about November 16th. That's almost it's actually a little more than 45 days, almost 53 days. So in the next 53 days, let's say the stock's going to go up to 85. How did these strategies perform? And that's really one of the key things everyone needs to look at in order to decide which strategy should I trade. So if Canopy Growth goes from $67.95 to $85, how much money do you actually expect to make? So if on the stock, you actually make a really nice 25% return if you had bought the stock and the stock shoots up to 85. However, if you bought a call option, you actually make a 79% return because it costs you substantially less to buy one call option versus buying 100 shares of the stock. But as you can see, the strategy here on the right gives me a 158% return if I am correct, and Canopy Growth goes up to 85. So this is really where it allows you to compare multiple strategies that you can't do when you're just looking at an option chain, and actually say, well, instead of buying the stock, if I bought a call option, how did these strategies perform? These are the types of things that you need to do in order to decide which one should I trade. And this is really why we designed the P&L simulator that allows you to put any three strategies side by side and actually compare them with different outlooks on the underlying stock. And you can even presume that what happens if the stock goes up to 85 before expiration date. What happens if it does that by the end of October? Let's say at the end of October, the stock hits 85. Here are the expected returns. You still make a 25% return on the stock, 86% return on the call, 104% return on the call spread. So this really allows you to compare these strategies side by side and say, which strategy gives me the highest return for any given possible outlook. Conversely, I think it's really, really important that people also understand the risks, because I think a stock like this has huge risks to the downside. These are stocks that are high-flying stocks. They have high implied volatilities, and it's not crazy for this stock to potentially go back down to $40 in a few weeks on some bad news or the market just simply realizing that they kind of bought into this a little too fast. So what happens if the stock crashed down to $40? If you had bought 100 shares of this stock, you'd lose $2,700. So a 41% return loss to your trade. But because you've paid so much, that's a huge dollar amount that you're risking if you bought 100 shares of the stock. On the call option, because you've only paid $1,000 for that call, that's the most amount of money you can lose. So no matter what happens, even if the stock goes to zero, you can only lose $1,060 if the stock craters between now and expiration. But lastly, the strategy here on the right, as you can see, only loses $733 because, again, you can only lose what you've paid for that strategy. So by paying the least amount for the debit spread, even if you're wrong on this trade, you actually lose the least amount of money. So that's really why this strategy here on the right gives you the highest options play score. We talked about finding a balance between risk reward and probability. That's really what the options play score is looking at, both sides of the equation, both probability and risk reward, and showing you what the true balance between these two strategies, between probability and risk reward, and how good is the true risk reward on the trade. Because as you can see, if you're right on the trade, you're going to make a higher return here on the debit spread. If you're wrong on the trade, you're actually losing the least amount of money. That's why the strategy here on the right gives you the highest options play score, and that's why this debit spread here on the right is one of the most efficient ways to take advantage of a bullish or bearish view on an underlying stock. So if you're looking at this trade and you decide that this is a trade that you want to make, you can hit the trade button. And first of all, what we do is we give you the details on how to enter this trade into your broker's platform, so that if you're trading the strategy at whatever brokerage platform you have in Canada, you can enter these trades as we print out in front of you so that you can enter this trade correctly. But more importantly, we also have what's called a strategy checklist. This is designed so that you understand your risks with everything that you're trading. We check to see if you're trading with the trend of the stock, a trend of the market, how good the options play score is. We even check the earnings date. Something that we see a lot of beginners tending to overlook when they're trading is making sure that you understand if there's earnings between now and expiration, because that heavily affects options pricing. And lastly, spread and liquidity. How liquid is the option that you're trading? Also something very important to understand before you get into a trade and not after, when you're trying to get out of that trade. So these are all the things that we tell users to look out for, especially if you're a beginner, making sure you understand your risks, okay? So this is just how you can type in. You can type in any stock and immediately take a look at some option strategies on how to take advantage of a bullish view on an underlying stock. And then what I'm actually going to do is I'm going to pull up Barrick's Gold as a bearish example. So this is a mining stock. Gold obviously has had suffered some severe losses this year. So these mining stocks have not been doing very well at all. I've noticed that Barrick's Gold not only is a relatively weak stock, it's got bearish trends. So the trend quality on this is pretty weak. And it recently bounced lower off of a $14 support level, which is a pretty important level here, in my opinion, on this specific stock. So let's say you're bearish on Barrick's Gold, and you think the stock might go back down to $12.50, $12 to the downside. Now, this is just for illustrative purposes. This is by no means a solicitation to trade this stock, nor do I necessarily even have a view on the stock. I'm just simply putting this out for educational purposes. As you can see, the stock is quite overbought on a technical indicator. On the CCI, it's telling me it's an overbought bearish crossover, telling me that it's generated a sell signal. So these are all the things that I'm looking for to potentially increase my odds of the stock moving lower. So now that I've looked at all these things from a technical perspective, it's hitting a double top, it's overbought, it's starting to turn lower. How do I actually profit from that, right? So if you're a stock trader, you would short the stock. Now, by shorting the stock, you need to be able to borrow the stock, you need to pay margin interest, and you have unlimited risk when you're shorting a stock. So it's not a particularly great option, in my opinion, to short a stock, especially when you have the ability to buy a put, which gives you the same downside exposure with limited risk. So here, to short 100 shares of the stock, you're going to have to post a certain amount of margin based on your brokerage account, but to buy a put only costs you $116. Conversely, to buy a put vertical only costs you $106. So not a huge difference in terms of the difference between the two, but as you can see, that $10 difference is going to make a significant impact on your overall returns just by reducing your trades by those $10. So we talked about what happens if Barrick's Gold goes down to $12.50. As you can see, if you had shorted the stock, you make a nice 12% return before you factor into your margin interest and other costs for shorting a stock. If you bought a put option, you make 115% return. So that's, first of all, right off the bat, one reason to take a look at buying a put option instead of shorting the stock. And if you look at the strategy here on the right, even though I've only saved $10 on the trade, which is less than 10% on the trade, as you can see, if the stock goes down to $12.50, instead of making 115% return, I make a 135% return. So a 20% return higher by saving the extra $10. And that's really, again, why one of the reasons that you want to consider using debit spreads when you're taking these type of directional views or directional trades, because it's a more efficient way allowing you to really minimize your risk, increasing your returns, and reducing and giving you better break-evens where the stock doesn't need to move as far in order for your strategy to be profitable. Conversely, I could be wrong and bearish gold, maybe gold might rally up to $15 over the next few days. It's just at $15 in early August. So it's not that crazy to say that by November, the stock might be back up to 15. So what happens if that happens? If you had shorted the stock, you lose $72. If you bought the put, you lose $116. If you bought the put vertical, you lose $106. So roughly similar risk profiles in terms of how much money you would lose. But clearly, if the stock goes in your favor, you're going to get substantially higher returns here on the right. So that's why shorting the stock and buying that put vertical have relatively similar options play scores. But as you can see, if the stock really does take off, meaning if gold makes a comeback and the stock goes to $16, as you can see, your risk here on the short stock is unlimited. So if the stock goes up to 16, 17, 18, you're going to continue to have more and more losses if you shorted the stock. Versus if you bought the put or the put spread, you have limited amount of risk to the amount of money you've paid. So that's really why we're not necessarily saying that this strategy here on the right is the best strategy all the time. But as you can see in the few examples that I've given, many times this debit spread gives you a lot of efficiencies that make it better for you to trade these directional strategies using these debit spreads versus just buying an outright call or an outright put or buying or shorting the stock. However, I do want to say that that's not necessarily always the case. Now, how can you tell? The best thing to do is using the P&L simulator, look at what happens if the stock hits your target to the downside, what happens if the stock goes against you and really just completely goes the opposite direction, how much money do you risk? And that's how you're going to be able to define, is the strategy here on the right, this debit spread, better for me? I think you're going to find the majority of the time the debit spread is going to give you better returns with lower risk. However, like I said, I do want to qualify that that's not necessarily true for every single stock. There's millions or billions of combinations of different stocks and different debit spreads that you can trade. There are cases where the debit spread is not the right strategy to make. So, but the only way to tell that is by putting the strategies side by side, giving you the tools to give you a starting point so that you have some spreads to take a look at to compare to buying stock, and then plugging in your own outlooks on the individual stocks so that you can quickly see what your expected return is, what your expected losses are, so that not only can you make a definitive and an educated decision as to which strategy you want to trade, but actually more importantly, in my opinion, know exactly what the best case scenario and worst case scenario before you get into a trade really makes it easier to take profits and cut losses down the line, because nothing comes to you as a surprise. You already have both possibilities in your mind before you get into a trade, so that when you kind of hit those take profits or cut loss levels, you're already prepared for it and you can just take profit and cut losses. You don't have to involve your emotional aspect to this as much, which is usually, again, one of the biggest indicators of success in terms of my trading, is people who are capable of creating a plan and being able to stick to that plan once they're in a trade. So with that, I just want to sum up, if you're looking at this type of strategy as an experienced options trader, OptionsPlay is really designed to allow you to type in any symbol and very quickly find a starting point for buying the stock, buying a call, or buying a spread. Or if you're bearish, being able to look at shorting the stock, buying a put, or buying a put spread, giving you the tools so that you can really analyze these trades and within a few seconds get a pretty good gauge as to which direction you want to go in. For those of you that are brand new, this is really designed to save you time, to give you some starting points that doesn't involve you searching through pages that look like this, where you really may not know where to start. And at best, you're making an educated guess, and at worst, you're picking strikes that don't make sense for you. So what we want to do is give you that starting point that already makes sense, giving you the tools so that you can analyze, which helps you explore and learn, and then hopefully inspires you to actually execute some of these trades once you feel comfortable with it. You might want to start off on a paper trading account just to get familiar before you move your way up to trading a real account. So with that, I just want to thank everyone for taking the time out this afternoon. What I'm going to do right now is I'm going to open this up for Q&A. So if you have any questions, please type them into the chat window or type them into the Q&A window, and I'll answer as many questions as I have time for this afternoon. Like I said, this webinar is recorded, so if you've missed out on anything or if you came in late, you will receive a recording with the slides afterwards so that you can help, so that you can follow along and see anything that you might have missed. So I have a question here. Will it be recorded? And yes, I believe I just answered that. It is recorded and will be sent out to everyone. Can you please explain what OptionsPlay Score and probability underneath? So I think I just explained that. If you missed that, please watch the recording, but the OptionsPlay Score is really telling you how well balanced risk, reward, and probability is. You don't want to just look at one or the other, because if you're just looking at probability or if you're just looking at risk reward, you're only looking at half the equation. And if you're only looking for high probability, chances are you have something with really poor risk reward, and vice versa. And that's why we don't look at each one separately. We want to look at the combination of the two, and the OptionsPlay Score is really telling you the combination of the two and how good that looks. Which Canadian stocks are good for debit spreads? So debit spreads are good for pretty much all large cap stocks and ETFs for the most part. But this has nothing to do with debit spreads. That just has to do with options in general. The more liquid the underlying stock is, the better you're going to be able to find liquidity on the options for it. The less liquid the underlying stock is, the less liquid the options are going to be, because options liquidity is simply a function of stock liquidity. So if you're trying to trade these, we generally find that you want to stick to the large cap names. That's really where you want to focus your options attention to anyway. Does OptionsPlay show the probability of winning for a spread? Absolutely. So you can click on the OptionsPlay Score, and that will break down all of the things that we look at to calculate the OptionsPlay Score. So you have probability of profit here. So as you can see, if you bought a put, you only have a 33% profit. If you bought a put spread, you make a 38% probability of profit. And this is the increase in break-evens that I'm talking about. So for this put to break even, the stock needs to go to 78.08 or lower. Here, it only has to move to 78.50 or lower. So 50 cents less the move that has to happen. That's why you have a higher probability of profit. How much open interest or volume should options have? This is a really good question, and a lot of people tend to use open interest and volume to gauge liquidity, when in reality, that's not what you should use to gauge liquidity. Options, as you notice here, open interest and volume tends to pool around the round numbers, and the numbers that have less, for example, the 65s will have more volume than the 65 and a halves. And this is really why we generally don't use options, open interest or volume to gauge liquidity, because the 67 or the 66 and a half strike is not any less liquid than the 67 strike. They're just as liquid because it's a function of the stock liquidity, not a matter of which strike it is. But on the surface level, the 67s look much liquid than the 66 and a half. But that's not true at all. So please don't use open interest or volume to gauge liquidity. A much better gauge for liquidity is the spread between the bid and the ask price. That will give you a better sense of liquidity. Open interest and volume. So something with high open interest and volume typically will tell you that it's very liquid, but something with low open interest and volume does not necessarily tell you that it's not liquid. So that's why we generally don't use that. We always use the spread between the bid and the ask price to get a sense for liquidity. I have a question here. If you click on modified and look on the expiry column, what does the number in parentheses mean? So that's a great question. So the question was, if you click on modify for any of these strategies and you click on the drop-down menu, what do the numbers in the parentheses means? That just tells you the number of days to expiration to that day. So the January 18th, 2019 is 116 days from expiration. That's what that number refers to. Roger's asking, on the P&L simulator, what does the volatility percentage refer to? Great question. So on the P&L simulator, there are three targets or three things that you can shift. You can shift the price target, where you think the stock will go, at what date you think the stock will hit that target at, and also volatility. So this is the implied volatility of the option. So at the current, we'll tell you the current implied volatility of Toronto Bank is 11%. If you think that Toronto implied volatility is going to go higher, this will tell you what the increase in profits to your trade is and the decrease in profits and how volatility affects your strategy. So this is something that you can utilize the volatility slider for. This is really for those of you that are a bit more sophisticated. However, I would argue that I don't know what you would look at to really know what Toronto Dominion's implied volatility will be from a month from now. So this is really useful more so for when you know for a fact that volatility will decrease, or you know for a fact that volatility will increase, such as around a catalyst such as earnings. Aside from that, for the most part, you would leave that alone and keep that where it is today. But great question. I have a question. How about we already own a stock and want to apply a repair strategy? So repair strategies are more personalized to your specific situation. I don't want to get into the specifics of that because that really gets us off topic here today. So Stephanie, if you have a question about repair strategy, please send me an email at info@optionsplay.com. I'm adding the email address to the chat window. So please email me your specific question about a repair strategy. I'm happy to kind of walk you through that. Trevor, excellent presentation. Is there a fee to use OptionsPlay for US? Yes, there is. However, if you use the slides that I send you, there is an offer for a discounted version of OptionsPlay. So please, when you get the recording, you're going to get access to a link that says OptionsPlay US with US stocks. If you sign up or register through that link, you do get a discounted 20% off of the cost of the US version of OptionsPlay. Bruno's asking, call vertical equals call debit spread and put vertical equals put debit spread. That is correct. So a long call vertical is a call debit spread, and a long put vertical is a put debit spread. Norman saying, where did you tell it to analyze spread? I assume you use it for straddles and strangles also. I'm not sure what you mean by where did I tell it to analyze? It's by these three strategies will show up as default. And the reason for this is because these are the three most popular strategies that traders use for trading options. Meaning if you're bullish on wheat, you buy the stock, you buy a call, and you buy a call spread. These are the three most popular strategies for trading an underlying stock. So that's why we default to these. But for those of you that want more advanced strategies, you can click on Modify. We have what's called a strategy constructor. So you can use this to construct all types of strategies. So if you want to look at butterflies, condors, straddles, strangles, you can do all of that just by a click of a mouse, construct a call butterfly or condor, and you can flip these. You can do all different types of things, move them all up one, down one. You have all this functionality to allow you to really play around with these strategies, and you can find those all under the Modify button. I have a question. How do I get free access to TMX for Canada? Again, in the slides that we'll send you, we'll have a link for you, specifically free access to OptionsPlay Canada. As you can see, that's the second link here. If you don't, you can also go to optionsplay.com/TMX. I'll put that link in there in the chat window as well. So if you need free access to OptionsPlay for Canada, you can go to that website that I just put into the chat window. Let's go to the Q&A box. There's a few questions here. Please show access to technical analysis. So if you want to use your own technical analysis, you can click on the expand button here on the chart, and then you have studies, which you can pull up popular studies. We have about 80 different technical indicators that you can add here through this chart here. So just click on the expand button on the chart in order to add your own technical studies. Where is the place to see delta? Great question. So on every single strategy, let me change this back to that call real quick. So let's say I'm looking at the November 16, 66 calls, and you want to know what delta it is. You can click on the expand window for each strategy, and at the very bottom, we have a button that says explain strategy in Greeks. This is where you can find the Greeks, both delta, theta, gamma, and vega, and we actually explain it to you in plain English. So for those of you that are saying, I have no idea what delta means, or I have no idea what this Greeks are referring to, you don't have to, because we actually really apply it or explain it to you in plain English, so you have a much better understanding of what these Greeks actually mean. I was unable to print contents of trade windows, which I would like to have in hand when I enter trade on platform, which I would like to file so I have a record of each spread I have traded. So one of the best ways to save a trade is you can just click on, so let's say I'm looking at this call vertical that I want to save. You can click on the expand button for the strategy, and you can actually just save that trade to your profile. So if you click on that share link, that will generate a link for you, and that saves the trade for you. So especially for those of you that are brand new and you want to paper trade and follow some of these trades without actually trading them, you can click on that save button, and then they're all saved in your profile. So you can go to shared trades, and all of your historical trades will show up here. So here, if you want to track this lead trade, you already have a reference of that, and you can click on the link again to show the trade. And this is how you would go about entering this into your broker's platform. When you hit the trade button, you have this type of information that you can copy or just directly utilize as you have your other brokerage platform up and running. I think this question about repair strategy I've already answered. Is OptionsPlay a free service, or is there a cost? So the US version is, there is a cost to it. However, the Canadian version with Canadian stocks is free of charge to you, thanks to the TMX. So for those of you that are trading Canadian securities, I highly recommend you to take a look at this. The link to that free access is available in the slides that we'll be emailing you out with the recording. And if you're interested in US stocks, we also have the links on how to sign up for that as well. Serge is asking, where do we see delta? I think I just covered that in a couple of a few minutes ago. Any other questions? It looks like that was the last question that I've gotten here. If there are no other questions, I just want to thank everyone for taking the time out this afternoon. Like I said, with options trading, especially for those of you that are brand new, this is not something that you necessarily pick up in a day. It really takes a bit of time of plugging in different symbols, taking a look at different strategies, putting them side by side and seeing how they perform. And perhaps for those of you that are brand new, trading them in a virtual account before you start trading your real accounts. And then for those of you that have traded, this is really designed to save you guys time. Finding the right strikes, finding the right strategies, then conversely being able to really compare different strategies that you've picked is really not easy to do if you're only looking at a page that looks like this. You're at best, you're giving yourselves an educated guess off of a page like this. What you really want to do is put strategies side by side, compare them, which really allows you to definitively say, which one's best suited for you, and for you to feel confident in the trades that you make, and confident in knowing what are the potential outcomes before you place a trade is really, really helpful for you to feel more confident in the trades that you make. So please make sure you take a look at the free version that TMX is paid for, and for those of you that are trading US securities, that the link that we'll send you allows you to sign up for this for US securities. Roger's saying, you once showed us how to use the probability bell curve to choose strike price. Could you show that again? Yeah, sure. So for those of you that are a bit more advanced, we have this probability range simulator that gives you an idea as far as what the one standard deviation move is for each expiration date. So let's go back to let's go back to TD here. Let's go back to TD here. So as you can see, if we use the range simulator, so TD is trading at $79.40. Let's just call it $80. This will tell you what the one standard deviation move for TD is for any given expiration date. So this is really more useful for those of you that are selling options than buying options. But as you can see, we've decided that to do the constructed debit spread, you want to buy a 78, the slightly in the money call, and then sell the 82s against it. The reason we're selling the 82 against it is because that's roughly the 1 standard deviation move. So a lot of users that are selling options like cover calls, credit spreads, even strangles and straddles, or strangles rather, they like to pick their strikes using the 1 standard deviation move. So let's say you want to sell a 2-week straddle, or strangle rather, you might want to pick your strikes where you sell the 78 on the put and then sell the 81s on the calls, because that's the 1 standard deviation move. So this is one way that you can pick your strikes, especially for those of you that are selling options. But also on the drop-down menu, we actually will tell you what the 1 standard deviation move is for each strike price for whatever expiration that you choose, so that you can actually pick those directly off of your strike drop-down menu. I have a question. Can you suggest a good reference book for options trading? I can. Just give me 1 second. I'm going to answer this one last question. Does the option chain show probability in and out of the money, or is delta sufficient? So great question. The question is, how can you tell probability by just looking at an option chain? And delta usually is a pretty good approximator. So, we've looked at delta before and seeing how accurate it actually is. And we're actually pleasantly surprised to see that delta was a pretty good indicator of the probability of an option being in the money or out of the money. So if you're just looking at an option chain, the delta usually is fairly sufficient. What happens when both calls go in the money? Can you explain what happens if you're assigned the stop? So that really depends on your brokerage firm. Most brokerage firms will net the two off each other so that you never have to take delivery or deliver any shares. But that really, that practice differs from firm to firm. So because you are always short one leg and long one leg, you can always exercise the long leg to deliver whatever you have to deliver on the short leg, or whatever obligation you have on the short leg. So that's something that you should always have control over, and your brokerage firm should be able to help you with that. In reference to the book, let me see if I can find this book. So this is the book this is actually an author. This is one of the top selling books on Amazon. It's called Understanding Options, the second edition by Michael Sincere. Michael Sincere is actually a subscriber to OptionsPlay, but he happens to be the #1 selling author on Amazon for options trading books. So this is really one of the books that I recommend, because it really simplifies options, very similar to the way that OptionsPlay is designed to make options simpler for people to understand. I think Michael and I share a similar philosophy in educating users on options. So this is one of the books that I generally recommend as a reference book, especially for those of you that are on the newer end of trading, a newer end of options. Any other questions? Raymond, thank you so much. I really appreciate it. Roger, thank you so much. Don, thank you. I really appreciate all the kind words. Peter, same thing. I really appreciate all of you that take the time out every few weeks to come to our webinars. For those of you that are in the US, we do these webinars every single week. For Canada, we try to do them every 3 to 4 weeks. So I really hope that you guys find this information useful. I will send out the recording with the slides, like I said, in about half an hour. So look out for that. It will include some important links that we've just discussed on this webinar, and includes the links to our previous webinars. So if you want to look at some of those, make sure you take a look at those. And thank you, everyone. I hope you guys have a great afternoon, and I'll see you in a couple of weeks.